Hello friends, my name is Vipul Aggarwal. Today I am going to tell you about how can you start investing in the stock market. To start investing, first you need to have a demat and trading account. It is very simple these days. It is as simple as opening of a bank account. You can approach to any of the brokerage firms like HDFC, ICICI, Edelweiss, India Infoline. So they will help you in opening of a demat and trading account. Now you have demat and trading account and you want to start investing. So there are three options. First is IPO. Second is mutual fund. And third and the last is you can directly invest in the stocks. I will start with IPO. IPO is initial public offer. That means it is first time offer for sale of a stock by a company to a general public. The share would be newly listed on the stock exchange. So if you consider sometimes even 2-3 IPOs come in a month, then should we blindly subscribe to each and every IPO? No. The answer is quite no. We should always do a brief background research about the company, its business, its promoters. Then only we should consider subscribing to the issue. And we should always consider the following things. Number one, what is subscription rating from various brokerage agencies? Whether they provide any subscribe rating, neutral rating or avoid rating. Then, second point is, what is the advice of various experts in business news channels? And one of the most important thing is, what is the response of the anchor investors? So who are anchor investors? Anchor investors are like mutual funds, pension funds, who know better about the fundamentals of the company and who do a detailed background research before subscribing to any issue. So these people are, anchor investor people are offered for subscription prior to general public. So we have the data. If the response from their side that they have overly subscribed to the issue, then we might also consider subscribing to the issue. We can also look at the financial parameters providing the prospectus like year-on-year profits, cash flows, sales volume growth, debt level of the company. And the last and the most important thing is valuation of the issue. Even if it is a good company, it has delivered in terms of profits over the years. But if the valuation of the issue price is on higher side, then we are left with little chance of getting good returns on listing as well as in long term. So this is all about IPO. Then I move to mutual fund. So if you are a working person, I cannot devote much time towards stock market, but you want to gain high returns from the stock market. So then mutual fund is the best option then you can look for. So what is a mutual fund? A mutual fund is a pool of funds collected from large number of small investors like us, and that is being managed by professional fund managers who are experts, who are professional in their field, and these people can pick good stocks that can provide good return over long term. So there are various types of mutual fund like sector wise IT, pharma, capitalization wise small cap, mid cap, large cap. Then we have ELSS tax saving funds. So these I will cover in a separate video. But the question arises, how should we choose a mutual fund? So which mutual fund to invest on? So a list of top performing mutual fund is available on business sites like moneycontrol.com, Economic Times. Then we can also refer to business newspapers like Business Standard, Economic Times, Mints. So we can look at this list and we can pick and choose our schemes of mutual fund. How we can choose? We can compare the annualized return of last 3 to 5 years, then rating from credit rating agencies, and accordingly we can make a portfolio of our mutual fund. So there are two ways in which you can invest in a mutual fund. You can start a monthly SIP in which a fixed amount gets debited from your account on a monthly basis, or you can also invest on lump sum basis. But we should always try to invest a larger proportion of savings when the market is down. And we should never invest total amount of our savings in a single mutual fund. We should apportion our savings in different categories of mutual fund to manage our risk. So that is all about mutual fund. Then I move to third option, directly investing in the stocks. So if you have significant time and interest to devote toward the stock market, then you can also look towards directly investing in the stocks. But as a beginner, I would recommend you should always start with Nifty 50 companies like Reliance, Maruti, HDFC Bank, Eicher Motor, ITC. So these are good fundamental companies who will deliver an investor in long term. So while picking a stock, we should consider the following things. What is the quarter on quarter profits of the company? Is sales volume growth, brand value, future potential, market shares, valuation. So these all look very heavy words. I will explain them in a very simple example. All of you must be aware about the company Maruti Suzuki. So if we consider the stock price of this share has increased up to thrice in last 5 years. What is the reason for the same? Maruti Suzuki is leader in the auto industry in India. So it commands over more than 50% market share. And has such brand value that it launches a new car in every 6 months. And some of its models like Vitara Brezza, then it's Baleno, so which had waiting period up to 3 to 6 months for years after their launch. And this company have delivered very good in terms of the net profits quarter on quarter and its sales volume growth quarter on quarter, very good parentage and very good future potential in terms of the increasing demand of four-wheelers in India. So we should always try to invest in a good stock which can provide us a good return in long term, and we have least risk of making losses. So these were the three options. Apart from this, I will also like to give you a few tips based on my experience. First is patience. Patience pays in the market. So market has always rewarded the investor in long term. If you consider the Nifty 50 index started with 1,996 and it has recently crossed 11,000 mark in 2018. It means rupee 1 invested in 1996 has become 11 rupees in 22 years with lots of up and down. And this is only about index. So there are various superheroes among individual stocks like Infosys, Reliance, Maruti, ITC, Eicher Motors. So these shares have even provided returns of about 100 times of their issue price in 15 to 20 years. So you can look at, if you are remain invested, then you can get good return in long term. So whenever you start investing, it might be that you incur some losses in the beginning, but you should not be panic. You should remain invested and you will get good return. Second point is proportion of the saving. So how much proportion of the savings we should invest in the stock market? According to me, you should never invest more than 50% of your savings in stock market at any single point of time. You should always keep some amount in liquid form for your daily and emergency needs. And last one is timing of the investment. So timing of the investment is very important for getting good returns from the market. So what I observed in last 5 years, so market always provide an opportunity in at least once in 1 or 2 years, where the stocks cracked up to 40 or 60% from their high levels, and they are available at very lucrative or attractive level. So for example, you must all have heard about demonetization 2016. Recently we had trade war between US and China and high crude prices. So the stocks are available at very lucrative level. So this is a time that we can enter the stock market and get the stocks at cheaper price. And there are good chances that we get good returns from the market. So thank you friends. This is all from my side. If you found my video interesting, please like my video and subscribe to my channel. Happy investing for updates. Thank you. Bye bye.